Hello students, this is Professor Vincent Osaya. Welcome to my class. This is the presentation of part 2 of chapter 3, the adjusting process. At the end of part 1, we talked about the time period concept. Now let's take a look at the revenue recognition principle. Recall, a big part of this class is understanding accounting rules, or we also call them principles, and how to apply them in order for us to create information for information that is used for decision making purposes. So that being said, let's take a look at the revenue recognition principle. The revenue recognition principle states that revenues are earned or are recorded when earned or recognized when earned. And the amount of revenue that needs to be recorded reflects the selling price or the service that was provided. So, two issues here: when to record revenue and the amount of revenue to be recorded. Moving along, still talking about the revenue recognition principle, I want to bring to your attention here the word recognition in accounting also means record. When we say something is recognized, that means we are recording it. Ultimately, after recording it, we eventually will report it in form of reflecting it on the financial statements. So as you can see here, we say that revenue should be recorded when earned, recorded or recognized. This is a big deal, meaning irrespective of whether you receive the money right away or not, it doesn't matter. You need to recognize or record revenue. So like the example that I gave you, for a CPA firm, if a customer walk in and taxes have been prepared for the customer for $300, the CPA firm will recognize that or record that as revenue. Another customer come in and we do the work for him for $100, the customer could not pay. I say, I'll pay in 7 months. We still record it as revenue. So the most important thing is when it is earned. So as you can see here, we say that every company does one of two things. You are either providing services or selling goods to the customer as a way of producing or recognizing revenue. So moving along, let's take a look at another principle, the matching principle. We said that the matching principle states that expenses should be matched with the revenue that they have produced in a particular month. All right? Now, what does that mean? Let me give you an example. Let's assume that, remember, here's our income statement. Let's assume that we are in a janitorial business, and this month we did $20,000 worth of services, and here are our expenses. Let's assume that we have only one employee, and we pay the employee, let's do supplies expense, let's say $5,000. Now we have salary expense. Let's assume that we have one employee and we pay the employee $2,000 a month. Guess what? In this month, that employee is in a dire situation. The employee needs some help, and the employee said, boss, instead of paying me $2,000 this month, can you just pay me $6,000 for 3 months? In the month of, this is the month of January, right? The employee is so valuable to you, you pay the employee $6,000 in January for January, February, March. In other words, you pay the employee 3 months or 2 months ahead. So guess what? You cannot report the $6,000 as an expense for the month of January, because even though you pay the employee $6,000 January, February, March, you can only report $2,000 salaries expense. Why? Because only $2,000 relates to the $20,000 revenue that was produced in the month of January. So if you do $6,000 because you paid the employee $6,000 in January, then you distort the performance or the picture of the month of January. So in summary, the matching principle says that you should match expenses with the revenue that they have produced in a particular period, be it that month or be it that particular quarter. Otherwise, you mess up exactly what happened in that particular period. So that is what the matching principle is all about. Now don't worry, if we report $2,000 here, what happens to the other $4,000? Don't worry about that in terms of how we record it. We are going to deal with that eventually. So that is the matching principle. Now, we have completed, we have explained 3 important principles or accounting rules. We are going to talk about how to apply them eventually. So let's take a look at the objective 3. Here we are going to talk about the purpose of journalize and posting adjusting entries. As we indicated at the beginning of part 1, when we talk about adjusting, we are actually doing what? Updating certain accounts. Some, not all accounts, there's some accounts that need to be updated in order for us to produce accurate financial statements. Now, let's roll up our sleeves and let's take a look at what we have here. Now, you need to pay very close attention to this. As a matter of fact, I should have told you from the outset, chapter 3 is the most difficult of the first 3 chapters, okay? So you really need to pay attention here. Now, let's take a look at what we have here. Recall in chapters 1 and 2, take a look at certain things that we accomplished in connection with producing financial statements. Don't forget now, don't forget the big picture. We are going through all this craziness for one purpose and one purpose alone, in order for us to create financial statements or financial reports. And we do that systematically, not haphazardly. Okay, step 1, step 2, step 3, step 4, so on and so forth. So without you knowing, take a look at this. In the previous chapter, take a look at what we have accomplished. Number 1, we analyze and journalize transactions. So we analyze, in other words, we figure out the impact of each transaction on each account. So we have a transaction. Of course, you know what a transaction is. An event whereby an exchange takes place. We provide services for customers, that's a transaction. We buy equipment, that's a transaction, so on and so forth. So we analyze and determine the impact of each transaction on each account. Sometimes an asset goes up, an asset goes down, liabilities up, down, so on and so forth. So now look at this. Then the next thing we do is we journalize the transaction. What do you mean by journalize? Here is another fancy word in accounting. We say journalize. That simply means record the transaction in the journal. Instead of accountant saying record the transaction in the journal, don't forget now the journal is just a book that we record transaction in, but accountant will say journalize. So we analyze and journalize the transactions. Then number 2, recall, what do? We post to what? To the general ledger. Now, let's go back to number 1. Why are we doing this? We analyze and record the transactions in the journal because it makes good business sense to record every business transaction. Otherwise, we forget. Number 2, we post the transactions in the journal to the ledger. Recall, the ledger is another accounting book or accounting record that we use in recording business transactions. Okay? We talked about that in chapters 1 and 2, or in chapter 2. So we just open it and record the transaction in the ledger. Why are we transferring? In English, we say transfer. In accounting, we say post to the ledger. Why are we transferring information or transaction from journal to the ledger? Why? Because we want to determine the balance of each account. Recall in chapter 2 we did that. Then after we post to the ledger, what is the next thing we did? We prepared trial balance. Remember? Why? are we preparing? Why do we prepare the trial balance? We prepare the trial balance because during the process of posting from the journal to the ledger, you remember the posting process? You can easily make a mistake. If you post debit instead of debit credit, guess what? And you don't know it, when you prepare a trial balance, the trial balance will uncover that mistake. So if the trial balance is a list of all the accounts in the ledger with their debit and credit balances in order to check our arithmetical accuracy during the process of posting. So here you have it, and we call this unadjusted trial balance. Why do we call it unadjusted trial balance? Because this trial balance is not adjusted yet. Remember what we mean by adjustment? Meaning we are updating certain accounts that needs to be updated, not every account. All right? So the unadjusted trial balance comes from the general ledger as we indicated. Now, that being said, we talk about the three principles in connection with the reason why we make adjustments. Time period concept, the revenue recognition process, principle, and the matching principle. Now, let me take about 4 minutes or so to demonstrate the implication of not making adjusting entry. So you need to watch this quickly. Remember, we have, this is the format of the journal, right? Let's assume that this column is a distribution, this is debit, and this is credit. Let's assume that we started the company with $30,000. So we debit cash, $30,000, and we credit common stock, $30,000. All right? Now, let's assume that we provided $20,000 worth of service to the customer on cash. So we received $20,000 cash, and revenue is recorded for $20,000. Let's assume that we paid insurance at the beginning of the year. We decided to pay 6 months of insurance ahead of time, $1,000 insurance a month. So if we are paying 6 months insurance ahead of time for $6,000, that is an asset because the $6,000 will become expense when we use part of it. So at this point in time, we debit prepaid insurance for $6,000 and we credit cash for $6,000. All right. So when we are done with this, let's take a look at what happened. We post to the ledger. Now, if we post to the ledger quickly, here we have cash debit, common stock credit, cash 20, revenue 20, prepaid insurance debit 6, cash credit 6. So after posting to the ledger, then we need to determine the balance of each account. So we have 50, we have 6, the difference between this and this is 44,000. So we have cash for the $4,000 debit balance, prepaid insurance is 6,000, common stock is 30, revenue is 20. So after posting from the journal to the ledger, the next thing we do is we prepare trial balance. So if we prepare trial balance, take a look at what happened. Trial balance consists of what? A list of all the accounts in the ledger. In this case, we have cash, 44. We have common stock, that is 30. We have prepaid insurance, that is 6. We have revenue, that is 20. So if we do the math real quick, we have 50, 50. So the trial balance is imbalanced. So this trial balance, we call it unadjusted trial balance. Take a look at a summary. Assuming that we decided to prepare our financial statement with this trial balance without making any adjustment. Look at the implication. The income statement for this month will be recorded as what? Look at this. Revenue will be 20. Look at, if you take a look at this trial balance, there's no expense. So expenses will be 0. Then our profit on net income will be 20. Guess what? This income statement is wrong. Why is it wrong? Because at the end of the first month, the $6,000 insurance that we pay ahead of time, 1,000 of it has been used up. So we need to record or recognize 1,000 of the $6,000 insurance that we pay ahead of time. If we make an adjustment, then we would have an insurance expense of 1,000. Our net income will be 19,000, not $20,000. So that is a summary or the implication of not making adjustment to some accounts that needs to be adjusted before we prepare financial statement. I know that this is a little bit overwhelming. I just gave you an overview. We are going to go ahead and talk more in details as to how to make all these adjustments in order for us to prepare accurate, complete financial statements. So this is the end of part 2 presentation, and we will take it from here in part 3.